let's get into some stuff I wanted to do on the economy. This I wanted to do on Monday, but we decided to call it at 4 hours. The U.S. economy is not doing great, as we've been discussing for some time. So we're going to talk about something called the Buffett indicator for a minute. There's many different indicators within capitalism of where you are in the business cycle. So for people who don't know the business cycle, it was described by Marx and Engels. I mean, it's been known for a long time, like 200 years, that there are booms and busts. Why? They are what Marxists call overproduction crises. So basically, capitalism is productive, but then in order to protect profits and prices, it has to slow down, stop production, throw people out of work. And then after the excess commodities have been consumed, and so there's scarcity again, then the system can kick back into production and the whole thing starts again. But you're in this constant thing of boom and bust. That's not a thing that you can escape in capitalism. It's impossible. Actually, what we're seeing right now, and I'll put up my favorite screenshot that I've been spending a lot of time on. As I mentioned before, a lot of what I watch right now as far as YouTube and news that I read is economists talking about what's going on with the housing market, because this started for me in trying to understand the housing crisis, and then I realized we are in another 2008 type situation. So 2008 was the end. It was when the bubble popped, a bubble that had been brewing in '04, '05, '06, '07. And then when it started to crash, I mean, so much speculation was tied up in this that when the prices crashed, it really just brought down so much of the economy, and it caused a credit crunch where everybody's credit was hurt. Banks didn't want to lend to anybody. The government had to step in a massive way, and the Federal Reserve, and trying to alleviate this credit crunch and just basically throwing money at people to keep the engine, like it's like if your engine runs out of oil and just seizes. They were trying to prevent that with the economy by just keeping money flowing. But by the numbers, nobody had the credit to be lent to. So what we can see here is we're at the top, and it's almost the end of the ride of another massive, massive bubble, which is a huge deviation from the 130-year average. This chart goes back to the 1890s, and I want to credit Reventure Consulting, very rapidly growing channel. I started watching them when they were pretty small. I have like 500,000 subscribers now. The title of the video is "The Biggest Mortgage Collapse in U.S. History" is happening right now. So imagine you could go back to '06, '07 and watch the whole 2008, 2009, 2010 saga play out from, in real time from the top. Well, we're getting that opportunity now. I mean, I'd rather just have a stable economy, but this is what we have. We have, this is inflation adjusted house prices. So even adjusted for inflation, we're in a bigger bubble than 2008. Even if you want to say that, even prior to that, it's trending upwards a little. Okay, we're in a bubble at least as big as 2008. When it pops, yes, they're going to have all sorts of mitigation measures. They're really running out of tricks, though. And to a certain extent, you just can't escape this in capitalism, is the point. So it seems like we're at the top of a market that's about to come down in a big way. And they've been dragging their feet on this. That's where all this is coming from, is the boom-bust cycle. You can't stop it, but lately they've been trying to stretch it out with quantitative easing and all of these other things that, despite all of that, what goes up must come down at some point, and they are trying their darndest to slow it down, to delay it, and to pad the landing. And they're trying to get people, they're trying to keep people's confidence in the system so that the average schmuck investor keeps putting money in and doesn't pull their money out of the stock market or whatever else, and keeps the system going, because capitalism is exploitation and it does just prey on people's ignorance. And so that's why the big media is just telling people, oh, it's going to be fine, soft landing, yes, there's going to be a downturn, but you're not even going to know it's happening. This should be really interesting, like once everything shakes out, given where we're at with prices right now. But coming back to the Buffett indicator, this is like one sign of, named after Warren Buffett, because for a long time he said this was his favorite single analytic. It is total U.S. stock market value divided by GDP. So right now it is pretty high. It's 184%. So continuing here, and again, this is not a Marxist tool. It's something that the capitalist investors use. Let's see what it says. This ratio fluctuates over time since the value of the stock market can be very volatile, but GDP tends to grow much more predictably. The current ratio of 184% is approximately 51%, or about 1.6 standard deviations above the historical trend line, suggesting that the stock market is overvalued relative to GDP. Why does it matter? Well, if the stock market value is growing much faster than the actual economy, then it may be in a bubble. What's a bubble? Widespread overvaluation. Okay, so when that's the case, it's just being driven up by speculation and hype, like, for example, the AI hype, which they're saying, like, most of the rest of the stock market isn't doing well, but the, quote, Magnificent Seven stocks, the tech stocks, Google, Apple, Meta, Microsoft, NVIDIA, which makes the chips, and Tesla, I always miss one of these, but anyway, those big companies, they are doing well. NVIDIA is doing insanely well because they're the ones selling the hardware that everybody else is playing with. The rest of the stock market isn't at all. Like, if you take those 7 stocks out, first of all, they're a huge, percentage-wise, huge amount of the capitalization of the stock market. And so if they start doing badly, the rest of the stock market is just not going to do well. And we could see some major shifts happening with that, which we've been in this protracted period since 2008 or 2010. I mean, the economy started coming out of this in like late 2012, really. And they've been just kind of trying to make everyone forget that that ever happened ever since. Probably, though, we're on the cusp of this coming back in a huge way. So there's a chart of the Buffett indicator, number of standard deviations from the historical trend line. You can see that it's way above right now, as it was at the time of the dot-com bubble before 2000. It was strongly overvalued, and then there was a big crash. It was also overvalued, you can see there, in 2007 and 2008. However, that was driven by some other things than the stock market itself. But in this case, in this coming downturn, probably there's going to be a lot more stock market involvement. So anyway, it goes on into a lot of detail, but I just wanted to point that out. We've discussed a number of different indicators showing that we're in kind of a market high right now, and it is going to be probably going back down sharply soon. Which, why do we care as communists for this? Well, first of all, a lot of workers are going to be thrown out of work, but what does this mean? It means opportunities for agitation and education, because when things are sort of doing well or seem to be stable, people are less questioning of the system itself. When the system starts to shake underneath their feet, they go, oh yeah, the system I took for granted as always being here might not be here, and then what's going to happen to me? And we can come in and start explaining to people this is just another crisis of capitalism. It's inherent, and if you want to get rid of this and have a more stable thing, you have to get rid of capitalism itself.